Okay, 2 minutes after the hour, we're going to go ahead and start, and anybody else that can join will join us in progress. Good afternoon, everybody. My name is Bob McDonald with Preferred CFO. Welcome to our monthly Preferred CFO webinar web class. Um, I'll be joined today by Tara Crispin, who'll be our administrator for today's meeting. Today's topic is financial reports, shortcuts in analyzing reports, and what to look for in the data. Al Van Leeuwen will be our presenter. It's intended to be 40 to 50 minutes. If you have a question along the way, you can please use the chat function, or if it's a private question, you can use the Q&A button on the bottom of your screen. If you'd like some assistance applying to what this is in particular to your company, we can talk to you afterwards and make sure we can get with you one-on-one. With that, I'd like to introduce Al Van Leeuwen and today's topic.
Thank you very much, Bob. Really appreciate those of you who are attending, and I hope you enjoy this seminar. I will try to keep items fairly basic and for us to move along quickly. Once again, if you have any questions, please put them in the chat and we'll try to answer them real time if at all possible. So I will start out with giving you the objectives of what I'm going to be presenting. I'll be presenting to you the basic financial statements that you should be expected to see each month, at least for your businesses. I will also then have a brief discussion on financial statement variations because financial statements can be customized, and different businesses have different ways of looking at their financial statements. I'll then have a brief presentation on what creditors and vendors are looking for, and also as a shareholder, if you are a shareholder, what you as a shareholder would be looking for. So the three main financial statements that exist and are prepared and you should look at on a monthly basis: balance sheet, the income statement, and a statement of cash flows. If your company is similar to many of the others that I have worked with, most managers and executives don't really even look at the statement of cash flows. So we will spend a minute looking at those. But a balance sheet is a point in time measurement. It is the assets of the company, the liabilities, and the equity at a point in time. Everyone is familiar with an income statement, and it is your revenues and expenses and net income for a particular period. A statement of cash flows is very similar to an income statement, but it shows where did I get cash from and where is my cash going. Just because you have income doesn't mean you will have cash. And by the time you look at a balance sheet, it is probably already too late because a balance sheet is a point in time. And usually it takes accountants several weeks or a week to prepare the previous month's balance sheet. So financial statements should be viewed as a point of reference for you to make sure you understand what is happening in your business and where your cash is going. Financial statements are prepared using two-sided entries. As I have worked with other CEOs, how I've explained this is to say for every action, there is a reaction. If you're going to do something with cash, you need to tell, or the accountants need to tell you what has happened to that cash. If it isn't in the bank, they're responsible to tell you where it's gone. So everything has two sides to keep your financial statements in balance and working correctly. So why don't we just dig right in and look at a balance sheet. I have a sample company balance sheet. It was taken from a company I worked with in the past. And so this shows what a typical balance sheet might look like. If you see on the left-hand side are the assets. The assets is where we think we're going to get money from or what we think is going to be producing cash. And on the right side, you see liabilities, which is this is where my cash is going to go when I finally collect it. And stockholders' equity in the lower right-hand corner is what's left over. If I look at this balance sheet, just to do some quick analysis, I would say right offhand, this company is doing pretty good in the ability they will have to pay their bills because the current assets, which are $12 million, are higher than their current liabilities, which are $5.6 million. So if they collect all of their receivables and turn it into cash, they'll have enough to pay all the bills that will be due within the next 12 months because current liabilities is what is due in the next 12 months. But just looking at this balance sheet very quickly, I would have a question. And the question I would ask you is, this company had receivables of $5.9 million. But do you really think they're going to collect all of it other than $21,000? If you are receiving a balance sheet, you should make sure that your CFO is showing you what there is for an allowance for doubtful accounts. And also, if you have inventory, how much of the inventory they think is obsolete. Because many executives think, oh, I'm going to collect all of that $5.9 million or most of it. And if you're not getting the information on what the financial team thinks you won't collect or what you won't sell out of your inventory, that will be a problem. Here's something else that would be noticeable on this balance sheet for you to understand. Let's look at the long-term assets. When I look at the long-term assets, one thing is very apparent. My depreciation accumulated is $4.4 million. My equipment is $4.4 million. That means this equipment is probably old, it's fully depreciated, and it might need to be replaced. On the other hand, if accumulated depreciation was only $400,000, I would think that, oh, I have new equipment here. This valuation of the of the property, plant, and equipment is based on cost, what you paid for it. It's not supposed to be what it's valued now. Another area that can be critical to understanding a business is if there's any other long-term assets other than fixed assets. You'll notice here on this balance sheet, there are intangible assets. In fact, the intangible assets have a higher value than the fixed assets. This tells me if you're looking at a balance sheet or if you're looking at acquiring a company, you had better know what an intangible asset is because it could be a patent, it could be the value of customer contracts, or it could be just a number to make sure the balance sheet balances. So that's an important item to look at in case you ever have a balance sheet that has intangible assets. You should know what those are. One other quick item that I would point out on this balance sheet is retained earnings and current year earnings. If you look at this balance sheet, the retained earnings are 6.5 million. The current year earnings through November are $6 million. That means from January to November this year, this company has made almost as much money as it has in its past history. Well, it might be they earn $6 or $7 million each year, and the owners are taking money out each year and just leaving $6 million left. So looking at the ratio of what happens in your equity section is important. You should be able to see how much you have left in the company versus what your current year earnings mean or level are at. Now I'm going to take a look very quickly at, um, I just wanted to indicate to any CFOs that were here that the issues that a CFO should make sure to address for you is that you should have a listing of your intangible assets and test them for valuation correctly. Are they regularly? Are they really worth what you think they're worth? Are they making the amount of cash income you expect them to make? You should also get from your CFO supplemental information for key assets. You want to get any past due receivables, overdue payables, obsolete inventory, and on a regular basis, you should develop an exit strategy for asset sale versus equity. You should have that in your back pocket. Next, we are going to look at an income statement. This is an income statement of that same sample company, but as you'll notice in the heading, it's an income statement for the month, not year to date. This is simply for the month. Any financial statement you receive better indicate the time period that you're looking at. And as you look at this income statement, this was the income statement that this company used. Later on, we will possibly discuss why they have it presented this way, but there are some items that should jump out at you when you look at an income statement in this format. First of all, if you want to improve this company's financial performance by looking at this income statement, you should be able to see that the highest single cost is the materials. And so if you want to save money or make more money, you should focus on the relationship between the sales price and the cost of materials, because the cost of materials is what's truly driving the cost. Notice that the sales salaries and the salaries and wages for the administrative team are almost equal to the direct labor. So if you feel that labor, you should save money on labor, you would probably be looking at your administrative labor. Two of the items that are always on an income statement are depreciation, interest, and possibly amortization. When you look at these numbers, you should know that you cannot change depreciation or amortization month by month. It just doesn't happen. This is a cost that might last the same amount every month over 5 years. So you need to know and understand each of these cost buckets on your income statement and what drives that cost to change. So it would be very easy to look at sales, travel, and entertainment and say, if we are going to spend less, I can cut that cost. But then you need to understand if that is a lever that drives sales. And so understanding how the cost line items on an income statement drive sales or profit is critical. There's two other items on this income statement that if I were to look at it and give you advice, I would say as follows. The income tax expense of $5,602 versus income before taxes is way low. So let me see if I can highlight that. If you look at that income tax number, there's no way that a company should be paying that amount in income tax. So when you look at this, it's always important to look at your tax expense because many people forget about it. Another item of importance is this item here, which is your other income. This other income is very large compared to the operating income. It's over 10% of it. So this company is doing something to generate other income. You should be able to understand what is needed or what is causing other income to change. Once again, there are CFO issues that should be addressed. External versus internal income statements, there should be an easy map to understand what is on those different income statements. All internal statements should focus on major costs. There are different types of income statements, and we will look at them at a couple of these in a minute. But you should consider preparing income statements in multiple methods. It might be a contribution margin income statement. It might be a product line income statement. It might be a major customer income statement. One of the important items to note is consistency and application of your preparation of your financial statements helps decision making. And then if I were a CFO, I would consider having an activity-based income statement at least once a year. That's fairly a difficult process, but it can be very eye-opening. So then this is a statement of cash flows. Very few executives ever look at a statement of cash flows. But this has many items that tell you what is really going on with your cash. If you remember, the company had $453,000 worth of income, but their cash for the period was negative 53,000. So what happened? Well, if you look at this cash flow statement, you can see that the accounts receivable grew by $1 million. So even though you had great sales and great income, people aren't paying their receivables on time. So that cost your company $1 million, and your good CFO or accountant delayed paying accounts payable and accrued expenses, so at least you'd have some cash from your operations. In addition to having income, you also, in this company, bought $200,000 worth of assets, but to get some of that money, you sold existing property, and in addition, you issued debt. So a cash flow statement is critical to understanding where your cash went. If you're looking at your income statement and saying, I'm making money every month and we're always out of cash, you should look at a cash flow statement for the current month and on a year-to-date basis. It is very critical, and it's one item that too many people do not look at. So one of the tips for the CFO that I would have is a discussion of a cash flow statement should be part of every financial statement review. And if you aren't getting a review of your cash flow statement, you should ask for it. This is really a scorecard on how the CFO influences cash management. And there's a different way to prepare it that shows how much your customers are paying and how much you're paying your vendors. And you really should look at current month versus year to date. So those are the three basic financial statements that you should be getting, and a quick reference point for how to look at the financial statement and what should be there for you. Now I would like to proceed to talk about the different types of financial statements that I work on preparing. One is which a vertical or a point in time comparison. We will look at an income statement that's a vertical or point in time. We also have horizontal or trend comparisons. So you see the changes that occur over time. We have statements that are comparisons to expectations and comparisons to similar companies. The first item would be a vertical or point in time comparison. Let's look at this statement. This statement is a vertical statement, and this is all of the percents are based upon the total revenue. So if you look at this statement, you can clearly see that 46% of the costs or 46% of your revenue goes to materials. So if you're going to sell one other dollar, you'd spend another 46 cents on your materials. Interestingly enough, your manufacturing overhead is 19%. So as you look at these percents, you can tell where you need to focus on for cost savings, or you can look at which expenses seem out of whack. When I look at this income statement, I would say, if I were the CFO, I would collapse this income statement because you can see that advertising, utilities, and insurance and and amortization are all at 0%. And why not just add those all up and have an other category? There's no need to even look at some of those, providing they stay at a low level. You want to focus on the higher costs that are driving the problems. So, as a CFO issue, I would discuss with my CEO to only present line items that are X% of sales or higher, trying to keep it simple. So, this is a vertical income statement comparison with the percentages. Let's now look at a trend. Here is a trend income statement. This trend that I'm presenting here is a year to year to year trend. You can also have a rolling 12-month trend. You can have a 24-month trend. And so keeping track of trends are very important, because if you just look at the current month income statement or the current year-to-date income statement, you have no understanding if you're doing better or worse than you used to. So if you look at this income statement, if I were looking at it, I'd say, wow, look at that. I went from 9 million to $18 million in sales in 2 years. That's doubling growth in 2 years. I'm sure we would all love to double our sales in 2 years. However, looking down at the bottom, I have net income 2 years ago, and this year I have a net loss. Using the trend income statement, you can begin to identify what the problems are and what the issues are. And so, using the gross margin, you can see my cost of sales have increased more than my sales have proportionately, but not that big of a difference. Where the real big difference comes is in operating expenses. Well, going from 3 million to 6.6, so they've gone up 3.3 million, and the real issue is in other administrative expenses, going from 1.6 to 3.75. You can see the owners, who are the shareholders, used to get $700,000 a year out. Now they're only getting $400,000 a year out. So there's something going on in these administrative expenses where I would ask my CFO why administrative expenses are going up so much. What is it that's causing those to go up higher than they should have? Because at most I should only be spending 33% in my of my sales as operating expenses. So a trend income statement or a trend balance sheet or a trend cash flow statement can give you good insights on what is going on with your business and the trend of where you're going and where you might want to correct. So in this case, the shareholders are sacrificing to keep cash flowing into the company. The other type of financial statement is to compare to a budget or to an expectation. It doesn't need to be a budget, it can be a forecast, it can be something written on the back of an envelope. If you are running a business and you know the key levers, you should know that if I add 3 more customers, I should have this much more in revenue and this much income. Whatever it is that you're building your expectations on, this financial statement I prepared is based upon a budget. So if you look, and when I use a budget, I try to use the words better or worse. The reason I use better or worse is everybody can understand those. So a negative number is worse. I'm doing something worse. A positive number is I'm doing something better. So in this case, you can see my revenues are $600,000 worse. My materials are $93,000 better. Very interestingly, my labor is exactly the same, which means when sales go up or down, my labor isn't going to change. That's important to know as you're beginning to price out products or determine the capacity of your manufacturing plant or your service providers. So in this case, there's a budget versus actual report to be able to help you see where things are going better or worse. And one of the items here, if you look at this, boy, it sure is funny that the sales, salaries, and commissions have spent a lot more money, or you're doing worse. You're spending more money on your sales salaries, and your sales are down. That is that's a key indicator that you probably have an issue. So once again, having a comparison of actual to a budget or actual to an expectation can help you focus your efforts on making corrections where they need to go. One of the other items that is also important is that if you're only comparing to your own budget and you're only comparing to your own company and what you know, you might miss items that are critical, or you might miss items that are important to help you improve your company. So one of the items that should be done is to compare to similar companies. So I gather information for similar companies. I go to yahoo.com finance and I try to find companies listed there that have similar attributes or in my industry. I can go to known public companies, CC or Edgar process, and find the latest filings, or there are private company industry groups where you can get comparisons of your financial information to others' financial information. It's always important to look and see what known competitors are doing or others in your industry. So you should be able to ask your CFO to do a regular comparison of your financials versus someone else's financial statements. So then here we take time to prepare these financial statements, and people and other entities will ask for them. You might be trying to get a vendor and they might want financial statements. You might be meeting with a bank. They would like financial statements. And so there's a couple of things we should know that financial statements are used for. So creditors, or in other words, a vendor, if you're trying to get a vendor, they are primarily interested in a company's debt paying ability. Short-term creditors want to know if the company pays its bills on time, and long-term creditors want to know if the company can repay the interest they're going to be loaning them. So they will each hone in on different parts of your balance sheet and income statement. Short-term creditors will typically monitor the following. They'll look at your net working capital. That's defined as your current assets minus your current liabilities. So you should also be monitoring your net working capital on a regular basis to see if it's growing or shrinking. You will want to look at your current ratio, which is your current assets divided by your current liability. And then you will also want to see how you're doing on collecting your accounts receivable. Typically, that's measured by an accounts receivable turnover, which is your net credit sales divided by your average accounts receivable, and then calculate a very similar thing for your accounts payable. This should show you how you're doing at managing your short-term assets to meet your bill paying processes and how you can improve in those. Long-term creditors, on the other hand, look at something completely different. They look at the debt ratio. They want to know how much debt or liabilities you have compared to your total assets. They want to know the total liabilities compared to your equity, and they want to know how much you earn in excess of interest, and that's called times interest earned. They take the income before interest and taxes and then they divide it by your interest expense. They want to have a high number there. The higher number there, the better they feel. And as a final point of what you should be looking at with regards to what you're doing would be a shareholder return. What you want to measure as a shareholder or an owner or a chief executive should be the return on investment. So you should be focused on improving gross profit margin or measuring gross profit margin, looking at the bottom line profit margin as a percentage of sales, your return on assets, and which is your net income divided by your average total assets, and your return on equity, which would be your net income divided by your average equity. Also, as by way of valuation, one of the items that should be regularly measured is what you think the estimated market value of the company you're running is. And that can be determined by taking the EBITDA times a multiple. So if you think the multiple for your company should be 6, you take your EBITDA, which is your earnings before interest, taxes, depreciation, and amortization, multiplying it by the multiple, and then subtracting out your bank debt or your notes payable. And that should tell you what your company is worth, and you can measure that on a regular basis to see if you're growing the value of the company. So in summary, there are many different variations of financial statements, and you should craft them to match your expectations on what you think drives your business to growth and profitability. And you should work closely with your CFO in developing the leverage points and the KPIs to help you manage those expectations and to see what is going on your financial statements. And those are my prepared comments on understanding financial statements. And I do not know if there are any questions or comments.
Thank you, Al. If we have any questions, we'd be happy to take them now from the field. You can either use the Q&A or the chat. Al, looks like you were very thorough. Thank you very much. I don't believe we have any questions here that have come through. Once again, you can contact us outside of this meeting if you'd like to have a question as far as a specific situation to your company. Keep in mind, these are webinars that we do on a monthly basis. The next webinar is scheduled for March the 24th. The pros and cons of using a PEO, professional employer organization, explore the advantages of potential drawbacks, and gain insights to see if a PEO is a right fit for your business. Thank you all for your attendance, and we wish you a very good week.